What's up, everyone? It's Kirk here at Option Alpha. Sorry, just getting adjusted and situated. And today in the live stream, as I mentioned earlier, we are going to talk about why, or I guess the question always comes up, Kirk, if we beta weight everything to the S&P 500, why not just trade the S&P 500? What's the benefit of doing that? So before we even begin, I want to know why you think we should either trade it or not trade. So you can just answer it in the comment section right below. But here's where I'm at with this, and then I'll take some questions from people. So we posted on the Facebook page that we were going to be going live today, and then some people posted some questions in there. So I appreciate that. For those of you like Lauren, Sean, John, Ravi, etc., who post your questions, I appreciate it. So I'll make sure we get to those as well. So there's three reasons why we do this, why we don't just trade the S&P and we beta weight all of our other positions to the S&P, although we can trade the S&P, but not strictly, right? And the three reasons are Q, Q, Q. No, I'm just kidding. So that's literally the reason, though. That's like one of the reasons. That's one example. And this is the example I want to go through tonight because I think that this hopefully proves a point about what we're trying to do here. And the Qs right now, as we look at this right now, the S&P has IV rank at 20, right? So on a scale of 0 to 100, 100 being the highest it's been in the last year, the S&P is at 20. Now the Qs, which is effectively the market as well. And I get it, it's the NASDAQ, right, versus the S&P, but they track like almost very, very similar together. The Qs have IV rank at 45. So now if you take this on the outside, just looking at these two individual securities right now, both major market ETFs, both highly liquid, both highly tradable, you would probably try to favor the Qs over the SPY, right? Now, could you trade just the SPY and not ever do anything else, right? Because if you beta weight everything to SPY, why not just trade SPY? You can, but you're losing out on opportunity because if you trade the Qs in this case, then you've got probably like 2x more implied volatility, potentially a better edge than if you just traded SPY by itself. Does that make sense for those of you who are here right now? Hey, Kyle, what's going on, man? So does that make sense? You know, like why we do this? So the reason that we do all these other ETFs all the time, including earnings trades, including one-off stock trades here and there, is because when implied volatility is high, we try to get the low-hanging fruit. And so beta weighting then brings everything back together and makes it more S&P-like. So we still want to follow the market. We still want to use S&P or whatever benchmark you want to use, but you want to be able to go out there and have some flexibility to take something that is better implied volatility and trade that, but then adjust it to your overall portfolio so that you're still, following the same thing, right? I often relate it like if in like fitness or, like health or whatever, you're not just going to eat one thing all the time, right? Like apples may be great for you, right? And everyone's like, oh, you got to eat all apples. I'm like, well, what if you just eat like apples and bananas and fruit and, all this stuff? You eat it all together, but in moderation so that it all works together, right? It's the same thing you're doing in your portfolio with options. So I look like right now, and the Qs have really high implied volatility. XLV, which is a healthcare ETF, super high implied volatility. So we may not trade XLV all the time, right? But right now, its implied volatility in the last 2.5 weeks has gone from basically 0 to 45. So yeah, we might make some more trades in XLV, and again, beta weight it closer to SPY so that it fits into our overall portfolio. Same thing like IYR. IYR's got IV that's spiking up right now. We got XRT that's, fairly high. We got FXI, which is, decently high. So all of these things are much better right now than the S&P. And so that's why we don't trade the S&P strictly. Although we do trade the S&P, it's just never, like what we want to do. If you look at just even the VIX, I mean, the VIX has been so low for so long. That's basically a measure of implied volatility on the S&P. And you would have not had a really good edge in the S&P for the last 2.5, 3 years or so, or plus really. So that's why we don't do it. Does that make sense? Any questions on that so far? So I want to get to the questions that people did ask previously and kind of prior to this. So if you guys have any questions, let me know, and we'll get those answered for sure. Just by the way, tomorrow we're going to be talking about what to do when you hit a brick wall. So if you want to sign up for that one as well, or go in there. So question that Lawrence had, he said, perhaps it's interesting to discuss the topic of neutral trading or not, the recent bull market of the last month on the S&P. And the RUT suggests you were better to follow the trend instead of trading neutral or biasing your trades on average historical move of an index of 1%. So I think this is interesting as well, too. Obviously, we know the markets have an upward bias, right? So I think what you have to do, though, is just continue to adjust your portfolio. So here's the case in point. we know that the market's been moving higher, right? If you look at your beta weighted portfolio every single week, as long as you're monitoring that, you can see every single week that you're starting to get more and more bearish, right? So like that's the fallacy that people have when the markets go higher, is they start to sell more bearish positions. Your portfolio is already naturally bearish as the market goes higher, right? So if you make most of your money right now as the market sits, if the market goes higher, you're bearish naturally because you need the market to go back down for you to make money, right? So you're bearish naturally. So if the market continues to move higher, you should be just naturally adding more and more bullish positions, or starting to skew some of your positions more and more bullish, right? That's, I think, just a natural progression. So do I think that you should just turn everything around and trade bullish? No, I think that you'll naturally add more bullish positions as the market goes higher. And so I think that that's why, you still can be neutral and you still can monitor the beta weighting, but it naturally adjusts. It's like a self-correcting process. So as the market goes down as well, you should be adding more and more bearish positions to help readjust your portfolio. The ones that you have on are great. The bullish positions that you have on are there and will help if the market rebounds or whatever. But if the market's going down, you add more bearish positions. That's how you get around that. So Sean said, does your answer have to do with allocation within the S&P? No, it's not about that. I learned recently that various sectors are not equally allocated, and that tech is heavy in the S&P, of course, because you got like Apple, et cetera. And so, yeah, I think that that's why you have to just choose a benchmark and just follow it, right? So it doesn't matter about the sectors. If you trade a sector like XLV that we were talking about earlier, fine, benchmark it and throw it into your portfolio and analyze the whole thing, see how it affects it. Would it be possible to maintain a delta neutral portfolio versus various put spreads, credit spreads, and calendars solely on the S&P based on the underlying vega and delta? Totally. You could totally build an entire portfolio based on the S&P, and you wouldn't have to beta weight it because you'd just be looking at the S&P by itself. So if you had nothing around the S&P, no other positions, 100% you could build a portfolio there. But I'm saying that it might not be the best ROI trade at that moment, right? I think it was in podcast 45 or 44, something like that we did on the website, where we did pricing of strangles. We looked at one standard deviation, like strangle in the S&P, and we said, okay, for the same amount of risk in the S&P, could we possibly get the same probability of success better someplace else, right? And so we went out and we found, I think, like 10 or so, and like 8 out of 10, you got better risk to reward for the same unit of risk, like the same margin amount that you'd have in the S&P for the same probability of success. You got a better return someplace else. So why not do that, right? And why not just make sure that fits well into the portfolio? So Ravi said, which option strategy is suitable for trading the S&P with the market being so high, but keeps going higher every time we expect a correction? Well, the reality is right now is that we don't have any signs of a correction, right? And so corrections, although they could be a 5 or 10% correction, usually starts with some sort of like warning sign or shot across the bow. We get a 2 or 3% drop. And until we have that, we don't know that that's going to happen. So as I've said for 3 weeks now in the strategy calls with members, is that it's up until it's not. Really, that's the way I deal with it now. It's like it's up until it's not. And when it's not, then we'll start, kind of adjusting and thinking about that. So I think option strategy wise, you could do more put credit spreads for sure. That's naturally going to happen if you are beta weighting. And then, as the market continues to move higher, your original put credit spreads that were lower, you take those off, you add new ones, you take those off, you add new ones. I mean, you could be in a situation where you keep adding them higher and higher and higher. Of course, you still want to add some, bearish positions here and there. It doesn't have to be in the market, right? It can be in other securities that are out there that you can go bearish on. So like XLV, for example, XLV hasn't moved in a month, right? Like after today's move down, it's literally traded sideways for a month. So you could trade XLV bearish and you would have made money for 2 months, and you could add it into the portfolio. Now, is it generally tracking the S&P? Yep, but it hasn't gone up for the last month and a half, right? So that could be added into that as well. So let me just go through here these comments here real quick. Brian said, of course, this time I didn't put credit spread on Google earnings. They did awesome. Yeah, it's still within the expected range, which is good. So Google was good. I think Intel will work out okay. I think Microsoft is kind of questionable, so we'll see. Brian said, I've been doing the wheel strategy because I can just own the stock and wait for the price to go up. Problem is I can't do that with Google and Amazon because I don't have 100,000K to buy shares. So why don't they split? Wouldn't they get more people buying their stock and do more options? Potentially, right? I mean, they can split if they want to. I mean, I don't know. They could if they want to. It's a reason to split is so that you have more marketability of your stock, but it's also cool because people want, to buy those bigger companies. Some of those other companies like Google, though, they have, I don't know if Google itself has the minis, but some of them have the minis, right? So they have those mini options. And I don't know which ones, Netflix or like Tesla or some of those do, but they used to have those mini options that you could trade as well. So that was a reason why they didn't split right off the bat. Yeah, I think they have some of those in Tesla, so you can check those out. But yeah, we'll see. I mean, I don't know. I still think stock is inefficient. If you want to get into some of those bigger companies like Amazon or Google, just buy a deep in the money call for like 5, 6, 7 months out, whatever it is. It'd be way cheaper, than doing the actual stock, and definitely carries less downside risk. So everything's great when it's going up, but if it goes down, then everything is really crappy, right? And you have lots of leverage to the downside. So, okay, any other questions on this topic? Has this been helpful in kind of talking about this? I get this one a lot. This is a big question. It's like, why don't you just trade S&P? Because of opportunity, because you're not just going to buy one house in your life. If you're going to be a real estate investor, you buy lots of houses. Same thing with options trading. If you're going to be trading and trying to take advantage of the mispricing, then you try to take all this low-hanging fruit wherever it ends up being. That means you might rotate in and out of different securities at different points. I know gold was like a really big trade for us a while back, and now is not, because it's really, really low volatility, right? So you just got to kind of, move and flow with the market and watch different areas. So, well, hopefully it's been helpful. As always, if you guys enjoyed this, let me know. Give me the hearts or thumbs up, whatever works for you. And of course, if you guys enjoy this, please share it with other people that you think might find this interesting. Like I said, tomorrow we're going to try to get on a more consistent schedule here with doing these lives now that I'm back in town from traveling. And tomorrow we're going to be talking about like what you do when you hit a brick wall, like how do you go through that trading. And then Monday, we're going to be talking about how portfolio allocation affects overall returns. And we're going to be running through a couple different back tests, which I think will be interesting. So kind of using the back testing to see how different allocations affect performance. So do you allocate more when it's a good strategy? Do you allocate less when it's, a good strategy? How does that actually end up, with long-term returns? So I think you guys will enjoy that as well. We're going to go through a couple different scenarios in there. So as always, hopefully you guys enjoy these. And until next time, happy trading.